Welcome back to Career Chats with Laura. In my previous credit risk modeling video, I covered the business understanding and regulatory foundations of credit risk modeling. Today, we'll take a deep dive into the heart of the modeling process, the data. Since data preparation makes up at least 70% of the modeling work, it's crucial to get it right. Data-driven models rely on the data being complete and accurate. No matter what fancy modeling techniques you might apply, at the end of the day, if you put garbage in, you'll get garbage out. This video will get pretty technical, so feel free to leave questions if you want to understand anything better. What data sources do we use for credit risk modeling? Depending on the size of the portfolio, the frequency of default or loss events, and the length of the data history within the bank, we may choose to use internal data or supplement with external data for modeling. The events we are trying to model are default and loss events, so if there's not enough of them in the bank's data, which is typical in wholesale portfolios, then we may need to supplement with external default data. Generally, the longer data history we have and the more accounts and borrowers we have, the better it is for modeling because we would be able to capture more default events. Depending on the type of model and the portfolio, we draw from various data sources. We could be using client and account month-end snapshot data, which contains the client's balances and account status by the end of each month, or transactional data, which contains one record per transaction. We could use data from internal collection systems, credit bureau data, client's financial information sourced from client inputs, macroeconomic data, and so on. In terms of sourcing data, we don't get too creative like trying to source social media information or anything like that. Because credit risk modeling is highly regulated, models need to be transparent and make business sense, so you can't just use random features. Imagine that you got turned down for a mortgage because of some social media post you made. Now that wouldn't be acceptable. How do we obtain the data? To obtain internal data, we typically pull the data from a data warehouse or a data lake. If the data feed is not automated, then sometimes we get spreadsheets from the business. If we need to supplement with external data, we may search public sources and download data or purchase data from vendors. How to gain data understanding. Once we get the data, we'll want to gain an understanding of the data. What granularity levels are our tables at? What are the key columns? What is the definition of the columns within the table? How does the data line up with the business process? Business and data understanding go hand in hand. If you haven't seen my business understanding video, check that out to get a sense of the business process. You'll want to try to do some basic visualizations of the data, the distributions, any trends, any relationships between variables, and so on. This is just preliminary. You'll also need to perform further exploratory analysis after you've fully prepared the data in order to find features that have strong relationships with your target variable. That gets into the feature selection realm, which I'll cover more in depth in my next video. How do we check the data and evaluate data quality and completeness? This is a very important part in credit risk modeling since our models are largely data-driven, so garbage in, garbage out. Regulators also keep an eye on the data controls process and how we justify that our data is complete and accurate enough. We use historical data, so it's important that the past records are complete and accurate, not just the current ones. That sometimes means that the bank needs to go back and check historical records, which can be a big undertaking. We're talking about data teams and business lines going back into the old paper records and matching that to what was entered into the database. The credit risk modeling team wouldn't necessarily be doing this, but we rely on that process upstream for the data. On our end, we can check for data completeness by first checking if we have all the columns or features we may need for modeling. For example, we'll need ID columns like client ID or account ID so that we can differentiate records from each client and be able to match up their records over time. We'll need columns that will be used to define our target variable, such as default or delinquency indicators. We'll also need columns that will be used to define our features like transaction data to define client behavior. Once we ensure we have the columns we need in our dataset, we need to check whether there are any missing values or unexpected values in those columns. A missing value is when there is a row in the table for the record, but the column we're checking doesn't have a value. Unexpected values are when we know the value of a column should be within a certain range or take on certain values, but we see something outside of that normal range. If there is a significant number of missing values or unexpected values, we would need to investigate why and follow up upstream. Another possibility is that we could be missing rows in the table we pulled. We can check for this by reconciling with different sources to see if they have the same number of rows and joining the tables to see which rows are missing. Sometimes the data does not reconcile, and we will need to dig into the reason why that is the case. If it's a small difference, we may argue that it's not material enough to make a difference to our model calibration. But if it's a big difference, then we need to try to remediate the issue by going back to the data source. Another common check is for consistency or trend over time in terms of the total number of records or total balance. If you suddenly see a spike or a drop, does that tie out to some sort of event? For example, a huge promotion to onboard a bunch of new clients in a short period. If there is no business explanation for the abnormality, it could indicate data issues, which warrants further investigation. We should also check if there are duplicates. For each table, we should have a set of key columns for which we expect there to be no duplicates when grouping by these key columns. For example, the month-end snapshot data at the account level, we would expect there to be one record per account per month-end. But we do not expect there to be one record per client per month-end, since a client can have multiple accounts. If we find duplicates, we would need to determine which record is valid and how to treat them. To be able to clean and process the data properly, we would need to have the right business understanding of what's going on. That will impact the logic that we apply to clean the data. For example, if there are missing values, then we wouldn't just apply imputation methods to fill them without understanding why they're missing in the first place. Based on the data quality checks as well as business understanding, we would identify key issues in the data that needs to be addressed through cleaning. If the issue does not impact a significant number of records or clients with significant balances, we may justify simply removing these rows due to these records having immaterial impact. Otherwise, we may fix records by replacing or filling in values. Now, for processing the data, in order to get it into a format that would fit into a model, we would need to consider the possible modeling approach and what format the model needs to ingest the data. Generally, you will need to prepare a table with the target variable as well as feature variables. Once you finish this step, you will be able to start modeling. First, you want to define your population of interest. Which clients or portfolios are you looking to model? You will need to be able to identify them in your data, and you may need to apply filtering rules to obtain that population. For example, if you want to model credit card default, then you'll need to identify which accounts are credit cards and keep only those accounts. You may also want to keep legit accounts and not fraudulent accounts in your dataset, since fraudulent accounts may skew your data when you're interested in credit risk and not fraud risk. So, you may need to apply filters to remove fraudulent accounts. Essentially, you need to have a clear definition of your modeling population and have the necessary data elements to identify them in your data. When you define your population, you'll want to think about what granularity level you want to model at. Typically, you would consider between loan level or client level. While loan level approaches are common, you may be able to use a client's behavior across different products to assess their likelihood to default, in which you may want to model at the client level. Another dimension to think about when defining your population of interest is the time period and performance windows that you are interested in. You may want to capture a longer time period so your model will have more information to train on and can capture the relationship between the features and the target through time. Or, if you believe the older data is no longer relevant or has poorer quality and could add noise, you could select a shorter time period. The performance window is the length of time that you track a client or a loan in order to see how they perform over that period. This will allow you to calculate your target variable. Next, you'll need to define your target variable. What target are you trying to predict? Is it the probability of a client becoming delinquent or going into default? Is it the loss rate once the client goes into default? Or is it how much the bank is exposed to when the client defaults? We will need to perform aggregations and transformations on the data to generate the target variable. Your target variable will be different depending on what you are trying to predict. For example, if you're trying to predict delinquency, then your target variable could be a binary variable which indicates whether or not the client became delinquent within the performance window. If you're trying to predict default, then your target variable would be a binary variable which indicates whether or not the client defaulted within the performance window. If you want to predict how much you would lose in the event of a default, your target variable would be how much you lost on a defaulted loan divided by the balance of the loan at default. These are called the realized values of your target variable because they are observations from your dataset. Here's an example for PD. Suppose we're interested in modeling 1 year default. This means our performance window is 1 year. What we could do is take our performing client population from the beginning of the year and track which of those clients went into default within that year. This means each client will have a target value of either 0 for non-default or 1 for default in this snapshot of data. We repeat this over multiple years, say from 2018 to 2024, which would give us 7 years worth of snapshots so that we can capture data from a range of economic conditions. For modeling LGD, the target is the realized loss rate. The calculation is trickier because after a borrower defaults, there is a recovery period where the bank tries to recoup the losses by going after the client and selling the collateral. But selling the collateral doesn't happen overnight, and recoveries could come back little by little, here and there, scattered across years. We would typically define the recovery period to be a certain amount of time and assume that no further recoveries happen past that time. This recovery period may differ by what portfolio or product we are modeling on. Then, we would track defaulted clients or loans after they default and see how much recovery has been made within the recovery period. Since the recoveries are made across time, we may want to take into account the time value of money and discount them back to the default date. Then the loss amount would be the default balance minus the total discounted recoveries. Other factors that could contribute to the loss is the operational cost of collecting and selling the collaterals. This could also be added to the loss amount. For the realized exposure at default, which is used to model EAD, we simply identify the outstanding balance on the default date and add in any accrued interest or fees. After we define the target, we then need to define some features. Features are variables that have a relationship with your target variable such that you can use the information from the features to predict what your target variable will be. In credit risk modeling, common features include the client's payment behavior, information on whether the client has previously been delinquent or defaulted, the client's financial status, which includes factors like income and total current debt, and so on, the value of any collateral, the economic environment, and so on. It's better to use features that are easy to explain as opposed to generating randomly calculated features and hoping they will be predictive. Ideally, you can leverage your business understanding to identify potential features so that when your model ties out to business sense, your model users will be more receptive to it. And that wraps up this deep dive into data understanding and preparation for credit risk modeling. If you found this video helpful, please leave a thumbs up and subscribe. Have questions or thoughts? Drop them in the comments. I'd love to hear from you. Thanks for watching. Bye.